Futures still weak this morning in the red after a tough session yesterday. For more on the markets amid all these events unfolding around the world and Venezuela, other places, let's bring in Peter Boockvar, Chief Investment Officer at one point BFG, not BFD, BFG Wealth Partners, and a CNBC contributor. It used to be bleakly, and you were very bleak a lot of the time. Maybe that was part of the job description at bleakly. But are you less bleak or still feeling bleak about 2026, Peter?
Happy belated birthday, Joe.
Thank you.
As we manage money, it's not for me to call things as I want them to be. It's as it is. And we like some things and we don't like others, and we're long things that we think are going to go up. So I'm hopeful that the market is up again this year, as our clients would be happy with that. But I take things as I see them.
Well, I'm trying to understand what you just said. So you said for our clients, I wish the market would be up this year, but I call things the way I see them. Are you saying that the market will not be up this year?
I don't know what the market will be. We're long things that we think will go up. I do think that the interesting thing about the market in 2025 is that it became much more broader. International stocks were tremendous to the upside. Small mid-cap stocks finally joined the party. I do think in 2026, I think the AI tech trade is losing some steam in terms of its dominance. We've seen that with Oracle, CoreWeave. We've seen the market response to NVIDIA's report a couple of months ago. We've seen the market punish Meta for its excessive spending. I think that entire trade is becoming more differentiating, that we've reached a point where investors are realizing they're going to be winners and they're going to be losers. So I think that trade is going to be less dominant, giving the opportunity for other things to do well, with a continuation of outperformance in international markets, a continuation in this commodity bull market, which is right now in industrial metals, but I think will broaden out. Hopefully a continuation of outperformance in small mid-cap stocks.
If you were to just looking at from the top down, not from the bottoms up, which you're doing with, and that's obviously relevant for clients to try to anticipate the rotation to different parts of the market. But is it a positive environment for equities in terms of interest rates, in terms of earnings, and in terms of valuations?
Well, unfortunately, the U.S. economy and the U.S. stock market essentially is all in on this AI data center build out. With most of the growth in 2025 coming from that data center construction, and of course, the U.S. stock market, specifically the S&P 500, obviously being dominated by these names. So as those stocks go, and as that build out goes, so goes the market, so goes the economy. The question is can the baton be passed on to other things? I hope it can be. I hope it can be passed on, and both in terms of growth and the stock market. You take CapEx, for example. All the CapEx growth in 2025 was the data center build-out. CapEx X that saw no growth. Hopefully in 2026, with the tax incentives in terms of immediate expensing, hopefully CapEx and other parts of the economy can maybe take that baton. So I think that investors need to not just blindly rely on that AI tech trade as a leadership group and understand that there are a lot of other parts of the market that can do well. Now, with respect to interest rates, yes, we're going to get more central bank rate cuts, but long end rates are not accommodating that cut in short-term rates, not just here, but around the world. The ECB has cut rates 200 basis points, but French and German bond yields are higher than when they first started cutting interest rates. We know the BOJ is raising interest rates, and seemingly every day long-term interest rates are rising there. And the U.S. 10-year still remains stubbornly stuck above 4%. And while I agree with Trump that we need to increase defense spending, well, then you get to a whole discussion about U.S. debts and deficits still being out of control. That at some point, I think, does matter for the U.S. Treasury market, because I do think debts and deficits now matter because sovereign bonds are being put into question in terms of duration and the appetite of investors for those countries that have excessive debts and deficits.
I guess I was just asking, do you expect earnings to be up this year? And if so, how much? And if you assign a multiple on those earnings, does the multiple stay where it is, or do you expect it to contract? Because then we can decide whether overall the market's cheap or expensive. So does earnings go up this year, and how much?
Yeah, I mean, I know I'll just grab the consensus being up, 10+% on earnings.
So what about
I think
multiples?
the multiple will depend on where the 10-year yield goes.
Okay.
The 10-year yield goes to 4.5 to 5. The multiple is going to be contracting, not expanding.
Okay.
And if
that's
we lose
possible,
the AI tech trade, then that's obviously going to be a drag on the S&P relative to other parts of the market.
Right. Okay, because for the earnings side of things, it does seem like there's some stimulus coming from, deregulation and the big beautiful bill and all those, maybe lower. I mean, the tax cut from $57 oil, all of those things. But if the bond market doesn't cooperate on the long end, you're still 40 trillion is a big number, and we don't talk about it enough. No one hasn't done anything yet for the total debt, but guys like you, I know that. I mean, did you sleep at all last night?
I sleep well every night. As I mentioned, I think when you look at the bond markets of Japan, Germany, France, the UK, I think debts and deficits now matter in terms of investor appetites for long duration bonds.
Okay.